spreads, butterflies, iron condors. Oh my! There are some very unusual names for option strategies, and if they sound a little intimidating, don't worry. We won't be getting into them in this lesson. But what we will do over the next few lessons is help you understand the different approaches to option trading. Option strategies can be broadly grouped into three categories: speculation, income, and hedging. This lesson focuses on speculation. Have you ever looked at a company's stock chart or read an analyst research report about it and thought the shares might move up or down? If you have and placed a trade on that hunch, you were speculating. Speculation means you're picking a side as to which direction a security might go. When it comes to options, if a speculator thinks a stock will go up in value, they can buy a call. And if they think a stock will go down in value, they can buy a put. Now you might be thinking, how is this any different than investing? Well, speculation is usually focused on short-term price movements. Having less time for your trade to be profitable usually means a higher degree of risk. Not all option trading is necessarily speculation. Even though all options eventually expire, some can be considered long-term investments. Options that have an expiration date more than a year away are known as long-term equity anticipation securities, or LEAPs. In fact, some LEAPs can have expiration dates that are as far as 3 years away. That said, options are particularly attractive to speculators because of the leverage they offer. Let's see how using an example. We'll exclude commissions and other fees here, but before you trade options in real life, make sure you understand your broker's fee schedule. An option trader named Jack thinks a stock is going to go up in price, so he buys a call trading for $2, which makes his total premium paid $200. His call option allows him to control 100 shares of the underlying company. The company stock is trading at $20 right now, so if Jack buys 100 shares, it would cost him $2,000. If the stock goes up by another $5 to $25 per share, Jack can sell his position and make a profit of $500. That's 25%. Not bad. But what about the call option? It's now trading at $7. So, if Jack sells it, he can make a profit of $500 as well. Remember though, Jack invested $200 in the option, meaning his profit would be a whopping 250%. That's the power of leverage. Of course, the benefits of that leverage come with a trade-off. Let's say the stock goes down by $1 to $19 per share instead. Jack would lose $100 on his stock trade, or 2%. But his call option is now trading at $1, so it's only worth $100. That's a 50% loss. Jack's call has an expiration date, and the stock may not move as he anticipated before the option expires. This means he could potentially lose his entire $200 investment in the call. So, unlike a stock, Jack will always have one factor working against him: time, as every option has a time value that decreases every day. That's how option speculation works in a nutshell. Whether your prediction about the direction a stock will move is based on hours of research or a single news flash, it's all just speculation at the end of the day. The key takeaway? Know the risks you're taking when speculating with options. Like we said earlier, speculation is just one of the ways to trade options. Watch our lessons on income and hedging to learn about the other two.